European stocks are falling this morning, trimming their biggest monthly advance since February. Neil Dwane is the Chief Investment Officer for European Equities at Allianz Global Investors, and he joins us here on set. Neil, great to have you here this morning.
Thank you very much.
Everybody's bullish on Europe these days, despite the fact that there's still no resolution over Greece.
Yes.
Unemployment is still double digits across the Eurozone, and it has already been a good run.
Yes.
The DAX is up at least 20% year to date.
Yes. Yep.
Why is now still a good time to buy European equities?
Well, I think with the quantitative easing from the ECB and the still consensual position that the Fed will raise rates, the euro will remain weak. That is good for corporate profits, and therefore we're expecting to see European earnings up about 25% this year, whereas I think US earnings are going to be flat. So for the first time, the earnings outperformance we've seen in the US is going to be the other way around. Europe is going to outperform. There's a lot of industry restructuring. You're watching what's going on in the telco sector. This is part of industrial policy from Brussels. So we think there's still a lot of attractive valuations, good dividend yields, and investors in Europe are massively underweight their own market.
Is it a bet on QE and financial engineering, or is this profit growth that you're talking about a function of the punch bowl being back and, there's still no top-line growth because the fundamental economy is still so weak?
Well, I think when you think about the fundamental growth, Europe is, if we're lucky, going to grow at 1.5% or 2%, but that's fine. Italy has only ever grown since 1990 at 0.7% per annum. So Europe doesn't expect a lot of growth. You look at the growth expectations in the US. You are every year expecting to get back to 4%, 5%, 6%. And guess what? You're going to be stuck at 2% like Europe is. But the valuations are very, very different. And so we think the valuation opportunity in Europe, because expectations are lower, is just so much more compelling.
People like to say, Neil, we've seen this movie before. We have seen the movie before. We saw it here with QE1, QE2, and QE3. And we put together a chart that shows how the S&P 500 did for the first 9 months of quantitative easing and how European stocks have done for the first 5 months of quantitative easing. They don't track each other exactly, but what it does show you is that the trend is in the same direction.
Yes.
Why even think about fundamentals? Why not just say, Mario Draghi wants me to buy stocks, so I'll just buy stocks, just like Ben Bernanke wanted me to buy stocks. We bought stocks, made money.
Well, because I think we're all, deep down after the last 5 or 6 years, we're nervous about the risks we're having to run to get any return. So I think we have to urge our clients and your audience to look at valuations, to look at the prospects, and so to have an eye on the fundamentals.
But so much of fundamental analysis was confounded during the QE period because it was so distorted. For example, highly leveraged companies under normal circumstances, right? High degree of leverage, high probability of default. Except in the equity world, highly leveraged companies were disproportionately rewarded during the QE cycle. Isn't the same thing going to happen in Europe?
Well, I think at one level it probably is, because that's part of the policy, and I think we're certainly expecting Mario Draghi to stick to his word that he will be quantitative easing through September next year. But I think with
a summer break.
Of course. Well, we are European after all. But I think that the flip side of it is you also got to remember Europe is almost unique in terms of asset allocation. The average investor, both pension fund, insurance company and individual, is 85% bonds, 15% equities and other things. They're not 50-50 like they are in the US. So if you look at the cash that's in Europe, over 2 trillion euros, you look at the negative yielding bonds, which rationally should be sold because they have topped out in terms of return, another 3 trillion euros, and the market cap of Europe is 8.5 trillion euros. Any movement in Europe to take a little bit more risk by buying equities, very supportive for the market.
Why don't you like European banks right now? A lot of people would say finally they've, paid most of the fines we think they're going to pay. They're finally well capitalized and they're paying out big dividends.
Well, I would question those last two assertions. If you look back in the history of the US sorting out the US financial banks, they ended up writing off between 12 and 15% of their balance sheets. Europe has written off 4% of their balance sheets. Now, I think the Eurozone banks had as big a financial crisis as the American ones, and they're hiding about €1 trillion of losses, which they can only take as and when they can afford to, i.e. when they're profitable. And what we're seeing, I think you're carrying stories on it this morning, what we're seeing in Europe, negative interest rates means a disastrous net interest margin for banks. So looking forwards, there's very little profitability, and very few of them have died yet, so competition remains very high. And we're also running with a new theme inside our equity portfolios, which is business disruption. And the industry that is the most unpopular, offers the least customer satisfaction, that is capable of being disrupted the most, is...
Cable.
Banks.
No, I know, banks. All right, Neil, thank you so much. We'll leave it there. Neil Dwane, the CIO of Equity for Europe and for Allianz Global. Thank you so much.
Thank you very much.